And welcome to our 2025 CPF Changes and What They Mean for You webinar. I am Vivian and I will be your host and moderator for today. And together with me, we have our CEO and CIO Chuin Ting Weber, as well as Albert Tan, our financial literacy trainer, who will be conducting this session. Before we continue, let's go through a little disclaimer. So do note that these slides are used for references and training purposes only and are not meant to be relied upon as legal interpretation or advice, especially when it comes to investments. Do note that this does not constitute as financial advice and past performance is not indicative of future performance. Right now, I would like to invite you all to take half a minute to just go through this disclaimer before we continue. Okay, so I'm also very happy to share that MoneyOwl has just relaunched. You might have seen us on CNA or on Straits Times just a few days back. And with MoneyOwl, we are excited to introduce that we are your financial advisor with a social mission. We don't do any direct selling. We provide you unbiased advice and we give product guidance as well. And with this, I think this lines up with our social mission to help enhance financial security in Singapore. This is the reason why we're doing this webinar. It's the reason why we do all that we do. And so with our agenda for today, it will be in 3 parts. The first part will be 2025 CPF Changes and its impact by my colleague Albert. After that, our CEO and CIO will be going through using CPF versus market instruments for retirement planning. And finally, we'll be answering any burning questions that you have. The Q&As will be answered at the end of the session as well. So do type in your questions in the Q&A box that you can find at the bottom of your browser. If you're interested in getting these slides, there will also be a QR code that you can scan at the end of the session to get these slides. And so let's begin.
Right. So CPF, basically it's what we call a self-funded scheme, right? So today you are working, CPF members along with your employers, you contribute into the various accounts, and depending on what age you are, you would have either previously, you would have either 3 or 4 accounts, but these days, regardless, you will just have 3 accounts. So if you are under the age of 55, you will have your ordinary, special, and MediSave account. If you are above the age of 55, you would have your retirement, ordinary, and MediSave accounts. So we'll go into detail how the changes have panned out in 2025. But really, I also want to just recap what are some of these usage for the various accounts that we have. So namely, I think most of us are very familiar with using our ordinary account for home financing, right? And ordinary account for home financing, right? And the primary purpose of CPF really is for our retirement income. And lastly, we also can use our CPF MediSave account for our healthcare financing as well. So it might interest you to know that we are paid pretty good interest rates on our CPF accounts. And you can see it in the bottom box on your screens now. So for those of us who are under the age of 55, still we have an extra 1%, right? So the base interest for our ordinary account is 2.5%, and the base interest for our special and MediSave account is 4%. So we have 1 more % on top of that on the combined balances of 60,000, subject to 20,000 from the ordinary accounts. Now today, if we happen to be in the age group above or equal to 55, or in other words, 55 years old and above, we will have an additional 1 more % on top of that 1% that the CPF members under the age of 55 they are enjoying, right? So the rule states that in the first 30,000 combined balances, you get an additional 1. So plus 1 on the first 30,000 and plus 1% on the second 30,000 of your ordinary account, retirement account, and MediSave account. So that's so much about the interest rates. I also want to share with us that in Singapore, when we talk about CPF, it's really to help us meet these three must-haves in retirement. And what are these three must-haves, right? So straight away, I think having a roof over our head is very important. And how does CPF come into the picture? Most of us, we use our ordinary account to buy our properties, right? So it can be a public property, it can be a HDB, it can be private property as well, right? Some of us may use only ordinary account money. Some of us may use a little bit of both. Some of us may even be just using cash, but definitely we know we have an option to make use of our ordinary accounts for that purpose. Now, secondly, which is also very important, especially in retirement, as our body ages, we tend to have more issues down the road, right? And therefore, we need that the healthcare coverage, and that is provided through our MediSave accounts. Now, how CPF comes in is that we have our MediShield Life, which provides basic hospitalization coverage, and we also have CareShield Life and the older version of that, the ElderShield schemes to help us provide for caregiving expenses in our old age. Now, finally, I think it's needless to say when we talk about retirement planning, we need a sum of money, right, for our basic living expenses. And I stress basic living expenses, and we will go through this over the course of this evening, that CPF really helps us provide that safe retirement income floor, depending on which age you are. From the age of 65, you have your CPF LIFE. From the age of 55, you are able to withdraw your ordinary account savings on top of your full retirement sums. Now, obviously, today, if you feel that it's insufficient for you, whatever CPF can provide, then you will need to look at other investments. Now, Chuin Ting will share after my section. She will share a little bit more in detail. How should we look at investing beyond our CPF? All right, so I'll just leave that to the later part. But today, really, I want to bring across some of these changes that have already happened in 2025, and I believe there were a lot of chatter, right? Online, in the papers, in the media, right? A lot of people are talking about closure of special accounts, but in actuality, there are 5 changes in law. Some of these changes are really worth mentioning, and today some of you may be hearing about some of these changes for the very first time. So let me just go through one by one each of these 5 changes, and I'll be going through in sequence from simple to complex, right? So I will touch on the more simple ones first, moving on to the most complex, being number 5, the closure of the special account for CPF members age 55 and above. Now, let's start off with higher monthly CPF ceiling. Now, for those who have not been up to date with CPF changes over the past few years, it might come as a surprise to you that this year the ordinary wage ceiling for your CPF contribution has been raised to $7,400. And in this table, you can see essentially these changes started way back in 2016, right? 2016 and through 2023, all the way to next year, they are slowly phasing in an increase in CPF contributions. So 7,004, it represents about the 75th percentile of income among employees in Singapore. There's no change to the additional wage ceiling, so nothing much on there, but perhaps it would help me by showing an illustration, right? What this means for us employees. So today, if we earn less than the wage ceiling of 7,004, let's say $4,000, right? And we are age 55 and below. This is essentially how it is, right? So we have $4,000, 37% because 20% from the employee, 17% from the employer, right? So that is the total amount credited to your CPF on the $4,000 salary, 1,480. And how much do you take home? Essentially, you just minus 20% of your employee contribution, and that brings us to 3,200. No difference. Doesn't really impact those of us who are earning less than the ordinary wage ceiling. But today, if you happen to be earning more than the ordinary wage ceiling, let's say $8,000 a month, then let's just go through the calculations again, right? So looking at 7,400, you do the multiplication, 37%, total that goes into your CPF accounts, 2,738. And how much do you take home? You less off your contribution and you add up that balance of $600, right? Then you right, the $600 from 8,000 minus 7,004, right? You get a take home of 6,520. Now, I can only show as many as 2 examples. Each of us will have slightly different income levels, but what's more important is that we want to be mindful of how this increase in the ordinary wage ceiling affects us. And perhaps it's even more useful if I were to share this statistic, right? And this is done in-house with the support of my team at MoneyOwl. We have run the calculations and projections with our proprietary CPF analyzer tool. And we have found that with the increase of this ordinary wage ceiling in 2025 and subsequently in 2026, based on this persona, this 45-year-old with 100,000 in his special accounts, other specifics are on the screen now. We found that there is an overall increase as compared to if there wasn't this ordinary wage ceiling increase, right? So in all over the period of 10 years, right, there will be a total of $67,000, right, increase, and that represents about 17% more as compared to if there was no increase in this wage ceiling at all. And the corresponding CPF Life payouts you see on the bottom row here is also quite significant, right? So a total of more than $480, right? So $488 increase, again, 17% increase just from the raising of this ordinary wage ceiling itself. So it is really something that is quite beneficial, especially for those of us who with slightly lower CPF balances to help us build up our retirement funds. Now, the second change is an increase in contribution rates for older workers. Now, I've highlighted the table. In the second and the third row, you can see the age ranges where CPF members will be affected, and they are basically from age 55 to age 60. Last year, you can see that the wage contribution is 31%. This year, it has been raised to 1.5%. It has been raised by 1.5%, right? And the corresponding amounts for increased from the employer and employee are shown in the table as you can see, right? And again, perhaps these numbers don't really make any sense. Perhaps it would be more helpful if I were to just show an example. So let's start with an example of an older worker who is 55 to 60 years old. So what does this represent? Again, I highlight the part the part of the contribution that goes into a retirement account, because that's where the 1.5% increase actually goes, right? It's really focused on helping us build our retirement funds, and retirement account is the account for that purpose. So for someone who is earning $4,000, this is the amount that goes into the various accounts. That is the corresponding take-home income. And for someone, again, who is earning $8,000, this is the corresponding amounts that goes into the various accounts. And that will be the take-home pay as well. Now, this is for age 55 and 60, right? How about for age above 60 and all the way up to 65? Now, that will be my next slide here. As you can see, again, I use the example of $4,000 following the various contribution rates with the increased contribution to the retirement account. In the last column here, you can see corresponding take-home income will be about $3,500. And if you are someone who is earning $8,000 in this age group, 60 to 65 years old, then this will be the numbers to look for you. Now, these numbers may not apply to you in my audience today, right? So how can you actually get these numbers? Very simple. For those of you who have the My CPF app, you can actually do a quick calculation by punching in your year of birth and the and your current monthly income, and the splits will be done right there for you, right? So I do encourage those of you who are keen to find out for yourselves, right? Especially if you are in that 55 to 65 age group, to do try that out for yourself so you can get a sensing, right? How does these changes affect you? Now, remember when I started talking about the various changes, I mentioned some of it are really worth talking about. And this is exactly the one that I want to share with all of us. And it's basically an improvement to the match retirement savings scheme. And this is what it is, essentially a dollar matching scheme to help our lower middle income seniors build up their retirement funds. So previously, you will see that there was an age range, 55 to 70 years old, and those seniors with less than basic retirement sum, they qualified for this match retirement savings scheme. The other conditions are as follows. So what is the improvement? Essentially, this year, the age cap has been removed. Again, don't worry, I'll have an example after this section to share in greater detail how this affects CPF members, right? So these highlighted in green are the key changes for this year. And next year onwards, you can expect that the BRS will also follow the prevailing BRS of 2026, right? And this is really quite a good change. Again, for those who are interested to find out whether or not you are eligible, or you're finding out for your parents or grandparents, right? Do log into this link that I have. And you can get a copy of the slides as well after today's session. So don't worry if you miss some of this information, right? Do check that whether or not you are eligible for that. Why? Because the benefit is that today, if you happen to be eligible for this, you get a dollar matching. In other words, today, you can put $2,000 into the retirement account of the eligible senior. CPF board will then top up a matching $2,000, and that is with a lifetime cap of $20,000. In other words, over a 10-year period, you can do a contribution of $2,000 every year, up to a maximum of $20,000, and the maximum matching grant that you can get is also $20,000. So I have a footnote over here to note that anyone can actually top up CPF members' accounts with cash, right? But only related your family members, right? You are eligible for tax relief. The conditions are mentioned in the CPF website as well. But more so, I also want to just share, right? Today, if you happen to be a family member, you're topping up for your parents, for example, right? You do get to qualify for some certain tax reliefs, right? Certain tax reliefs up to $16,000 a year. So how does this 16,000 work out? Basically, $8,000 for top up to yourself, another $8,000 for top up to your loved ones. Now, most likely, someone who is eligible, a senior who is eligible for match retirement savings scheme, there is unlikely to do a top up to themselves, right? Because they are already low income, right? So most likely, it will be the $8,000 tax relief that is eligible for loved ones, meaning the children or the other relatives of the eligible senior, right? So again, I have put the link here for the conditions for tax relief. It's very clearly stated, but I also want to just highlight one point, right? That the tax relief for the new upgraded, the enhanced match retirement savings scheme, only the amounts that are on top of above the matching grant will be eligible. And what do I mean by that? So I believe in my audience today, I have very filial children, right? Just like my friend here, Selena, right? So Selena, basically, she has this way to help with her parents' retirement. And what she does is that every month she gives them $200. So there is this consideration as well, right? Today, if you give $200 cash to your elderly parents, what is the likelihood of them either not using it properly? They'll just keep it in their bank accounts, or they may misuse it for whatever reason, right? It can be any of those possibilities. But today, you can also consider this as a way to show your filial piety as well, right? So instead of doing a $200 cash contribution to your parents, right? You might want to consider doing $200 every month into their retirement accounts, provided they are eligible for this scheme, right? So a parent's father is 71, her mom is 68 years old. They qualify with the one property rule, and they also have less than the basic retirement sum. So what it will look like for Selena essentially is now, so what it means for Selena is that if she were to do this top up to her parents last year, right, she would have only gotten an additional $600 of matching grant. But this year, if she does the same kind of top ups to her parents' retirement accounts, she would have gotten a total of $4,000 additional top up. Now, on the apologies, there's a slight typo here, right? The tax relief for Selena, right, will drop by a little bit, but essentially the amount of benefits really outweighs the amount of tax reliefs that she can get, right? So double-edged sword, right? Do consider this if your parents, your loved ones happen to be eligible for this scheme. Now, the fourth change that I'm going to cover this evening is essentially the raising of the enhanced retirement sum. So before even talking about what the enhanced retirement sum is, perhaps I want to just bring us through and have a quick recap of what happens, right, at age 55. So essentially, when you reach the age of 55, at the stroke of midnight, the retirement account is open for you. And what happens is that your balances in your special account will be transferred into the retirement account up to the full retirement sum. Now, if your special account is insufficient to meet the FRS, the ordinary account balances will then subsequently be transferred. Now, thereafter, your special account will be closed off. Now, what will this new change look like? Is essentially after 55 years old, you have this ability to push up your retirement account savings, right? So if you still have some leftovers in your ordinary account, you might want to consider topping it, transferring from your ordinary account all the way up to the enhanced retirement sum. Now, obviously, I want to also stress this point that it is a guide. It is a reference number, right? These retirement sums are what I like to call a reference number, and it is not a goal sum or a target sum, right? So we should not be too concerned. It's really just for reference purposes. So we take it as a reference. We can choose to top up to any amount that we want, and it doesn't have to be exactly the value that is on paper, right? The ERS. So this is how the numbers look like for 2025, right? So today, if you happen to be someone in my audience who is 55 years old, your basic retirement sum is 106,500, your full retirement sum is 213,000, and your enhanced retirement sum is $426,000. So your actual CPF balance, your SA and OA combined at 54 years old may be any number that is outside of these three numbers, right? So these are really just what I call reference figures, right? So don't be too concerned. Just take them for reference. But this can also guide us in telling us how much the corresponding payouts will look like in when you reach the age of 65, 10 years later, right? So today, if you set aside full retirement sum, you're looking at about $1,730 per month for the rest of your life, right? So I think that is a pretty good safe base to work on. Now, obviously, some of us will have slightly higher expenses, basic living expenses, and that is where you can consider you want to top up a little bit more, all the way up to the enhanced retirement sum, which will translate to about $3,300 every month. And for simplicity, for us to understand better, I've also calculated the current value of this number. So these are 10 years later, right? So today, what it looks like, those are the corresponding numbers. So it gives us a better sense of how it is going to look like for us as well, the actual purchasing power of these sums. Now, I've also done up the figures for 2026 next year and 2027, and we can see at this moment, CPI board has already published the retirement sums all the way up to 2027. From then on, we're not sure how much it's going to increase by, but let's not look too far ahead. This is what the numbers are for 2026 and 2027, and the corresponding payout amounts. So essentially, it is really trying to keep up with inflation as well, and to make sure that we can get a decent retirement income from our retirement accounts. Now, that brings me to the final change, or final CPF change of 2025, which is also the one that I think most members of the public, they are talking about, right? There's a lot of chatter. A lot of people tend to be talking about it. But I feel maybe more not so balanced perspective. And hopefully today I'll be able to share our perspective from MoneyOwl, right? Being really unbiased and conflict-free. I hope to share with all of you what this really means for members above 55. So this change has already been implemented, right? So today, if you're above the age of 55, you were to log into your CPF accounts, you will realize that what has happened on 19th of January was that your special account savings was transferred over to retirement account up to the full retirement sum. Any balance in the special account will be transferred to the ordinary accounts. Now, what is the implication? As many would have told you, or you would have read elsewhere, there is a drop, right? There's a drop of your total interest earned from 4% to 2.5% had the special account remained open, right? So this is this is how it would flow. But most people at 55 years old, they will continue to be working. They will continue to work, and they will continue to have working contributions, right? So what happens to your working contributions then? Now, let's say today you have already met your full retirement sum at 55. So let's assume that your retirement account is 213,000. So working contributions will now go to Medisave account first, followed by your ordinary accounts, right? And that's it. So very simple, very easy to understand. That is assuming your full retirement sum is met. How about a situation if your full retirement sum is not met? Then the contribution will first go to your Medisave account, followed by retirement accounts up to the full retirement sum, and then subsequently, if there are still surplus allocation, it will then flow over to your ordinary account. Now you realize there is still a little bit, right? Just now we mentioned there's an increase in contributions for older workers. That increase is only reserved for the retirement account, and that is how essentially all these changes are intertwined in one way or another, really to help our seniors build up retirement adequacy, right? So that is our final change. But again, to help us understand, right, very quickly, I'm just going to share two scenarios. And this is Mr. Tan I have in my example here. And you can see that Mr. Tan has already met his full retirement sum. He turned 55 6 years ago, right? So 2019, his full retirement sum was then $176,000. Now he continued working, and his contributions have grown his amounts like that. And on the 19th of January this year, what happened essentially was his special account was closed, right? So what happened? Because he has met his full retirement sum, the 80,000 in his special account has been transferred over to his ordinary account. Now, what can Mr. Tan do? He has the option today, if he wants to, he can transfer up to 134,000, everything into the retirement account. Now, he does not have to do that, right? He does not have to do that if he feels he doesn't want to lock up his money in the retirement account, because one thing is, once you have transferred into the retirement account, it is a one-way street. It will only be streamed out in the form of your CPF Life payouts, right? No doubt you will get higher payouts, but there is the loss of that liquidity in there as well. If he chooses to keep his ordinary accounts, the money in the ordinary account, then he can continue to use it either to invest them, or he can also withdraw because he has already met his full retirement sum. He can withdraw it to invest, or he can do a CPF ordinary account investment, which Chuin Ting will be sharing in a short while, right? Now, there is a third bullet point that you see on the screen here, that is that not many people are aware. Before you start your CPF Life payouts, you can actually have another window of withdrawal up to 20% of your retirement account savings before you start your CPF Life payout. So there is some flexibility still in this arrangement, right? So you don't really have to be too concerned about whether or not you should, what if you put all your savings into it or not. So really you have to think through what is important to you at that point in time, right? And the last bullet point is for those who are looking to have more withdrawals at 55 years old, then there is an option. If you own a property, you can just set aside the basic retirement sum and you will have the opportunity to withdraw even more. Now, how about for a person who has not met their full retirement sum? So not to worry. Again, like I mentioned, these are reference figures only. So in Mrs. Lee's case, the $8,000 in the special account will then be transferred over to the retirement account. Special account will then be closed. Again, the same considerations. She can either choose to keep the $10,000 remaining in her ordinary account, or she can choose to transfer it over to the retirement account for potentially higher payouts from her CPF Life. All the other benefits also do apply to her. Now, there's also additional help, right, given to seniors with lower CPM balances. Now, this will come in the form of retirement savings bonus, earn and save bonus, right? So as long as Mrs. Lee continues to work, her contributions will still continue to be allocated to her MediSave, ordinary, and retirement account, all the way up to full retirement sum, right? So essentially, that is how it is. Let's not be too concerned, right? Today, if you are someone who is maybe out of the workforce for some time, right? You're worried whether or not you are able to achieve these retirement sums. I say not to worry, right? Because these are, again, what I call reference figures, right? They don't really mean that much. It's really how much you have at the end of the day. So allow me to just quickly sum up, right? What are the impact of all these CPF changes? So firstly, we talked about the higher CPF salary ceiling. So what it means essentially today, if you earn more than 7,400, you have more income at retirement. And today, for those who are older seniors, right, you will have more retirement income by having an increased contribution. For those of us who are looking at the match retirement savings scheme, about 800,000 seniors, right, with low CPF balances will stand to be eligible. Previously in my slide, I shared only about 170,000 seniors have benefited from this so far. So do check that out if you happen to know someone who is in your family who is eligible for that. Fourthly, the increment of the enhanced retirement sum up to 4 times. So basically what that means is that you can have more risk-free interest accumulation after 55 years old, receive potentially higher CPF Life payouts as well. And lastly, the closure of special account. Really, we need not be too concerned about that because it was really only affecting a very small portion of the 55-year-old cohort. This was from the Parliament reply, right? Only about 1,200 of them were so-called eligible, right, to do this special account shielding, right? But we want to really, at the end of the day, to be very mindful that these CPF changes are really to help to enhance the retirement annuity income for the broad mass market and also vulnerable seniors. All right, so that brings me to a point in my presentation, and that's all I have to share on the impact of CPF changes. Now pass the time over to my boss, Chuin Ting, right, who will bring us through the considerations if you are using your CPF for retirement planning and using instruments outside of your CPF for retirement planning.
Hello, everyone. Thanks. Good to see so many of you here on our webinar. Thank you for coming. I think some of the questions being asked, they're being answered. No? Oh, sorry. I'll answer one very quickly. There was an early question. Is it MoneyOwl? Yeah, we're still around. We are now under Temasek Trust as a social enterprise, and Temasek Trust, as you may know, is a philanthropic ecosystem where all the entities here are part of a philanthropic ecosystem and dedicated to the shared purpose of doing good. And our mission is really to enhance financial security in Singapore for all Singaporeans and people living in Singapore. So when we talk about CPF, the reason we talk about CPF is really it should be the bedrock of financial planning, especially retirement planning in Singapore. CPF is a very highly rated system by international standards. We are like coming number 5, in the recent Mercer ranking, and there's a reason for that. And when you are approached by advisors and fund managers to do something because of CPF changes, I think we need to understand deeply what the usage of CPF is and how do we put it together. So coming from an investment background, sometimes what we see is, let me get to the next slide. Okay, so sorry, let's just we'll talk about that. Yeah, okay, great, thank you. Yeah, so coming from investment background, and could totally understand that when people talk about investments and whether you should do something, it's always about return. This return is higher than that return. This return beats inflation and all that. And definitely it is true. However, that is a pure investment thinking about maximizing returns or crossing certain hurdle rates and maximizing risk-adjusted returns. But that matters a lot to fund managers. But what really matters to you is whether you have enough when you need it. And that's the core difference between financial planning, in which investment is not an end in itself, but investment is there to serve you, your financial plan, which in turn serves your life goals. Having enough when you need it is the chief goal of all financial planning, and in particular, retirement planning. We're talking about having a reliable stream of income that is of a sufficient level. So from this lens, how do you plan for retirement as a Singaporean, citizen or PR, who has CPF? How do you balance, how do you put it all together? And here are the 4 principles that we recommend to you. Firstly, CPF LIFE should be used for your basic needs, as Albert has said. Now, I'll talk in colloquial terms. Let's not play with what you die must have. If you really must have that, please settle that with CPF LIFE, which is the most reliable source of retirement income. The second principle is let's have at least the full retirement sum in cash. This is what we highly recommend, and I'll show you why. Number 3, if you need more than that for your die must have income, then go beyond it. And if what you need, especially up to health span. Health span is basically when you are healthy, and in Singapore it's average 74.3 years. And so if you need some money on an inflation-adjusted basis, and that amount is higher than the FRS payout, then go beyond FRS and use more of CPF. Okay, sounds a little bit technical and tripping over some words here, but I will share that in some concrete terms. And fourthly, if you need an additional retirement income beyond what is CPF Life is able to offer you, assess instruments against our framework. There's a new framework that I'm happy to introduce to you, and it's very easy to remember because it has the acronym CPF and A. So it's what additional income do you need of a CPF? And they stand for certainty, probability, flexibility, and accessibility, and I'll go through that in a moment. Okay, so what is CPFA framework for retirement income? They stand for certainty, meaning that you know what you're going to get and you're certain that you will get it. The second is the probability of hitting your goals or probability of living the life that you want, usually to take into account inflation. So is there a probability that when 10 years down the road, 15 years into your retirement, when inflation starts to set in, is this amount enough? Flexibility, can you withdraw? Can you change your mind? And then very importantly, and this is often ignored in financial planning that focuses on only the upper end of the market, is it accessible? Is it affordable? And this has implications because if something is not accessible, the sizes are too big, you might be taking on too much risk. So how does CPF Life compare against this framework? Certainty of income? Yes, you will get that certainty of income for life, for as long as you live. The probability of beating inflation? Well, CPF is good with its high interest rates, especially in the special account for 5%, and even in the retirement account of up to 6%, until the point when CPF Life starts to pay out. And then it sort of flattens out under the standard plan. And this means that the probability of beating your inflation while you are in retirement receiving this payout is moderately low. Flexibility, we know that is low for CPF Life, but it's accessible really to everyone. So we describe this more in our in our retirement philosophy ebook. So what are the common objections to CPF Life then? Well, the first one I've already stated that, it doesn't index to inflation. And second one is like, while I really prefer the liquidity and the flexibility, I want to withdraw it. And the third is very common because, and this again comes from the understanding of CPF Life and CPF in general. CPF is not actually a bank account and it's not a investment account. It is actually an annuity, it's an insurance instrument. And as an annuity, the way that it's structured is that it does have some drawdown on capital or what you call the accumulation. Now, Singaporeans, we are addicted to two things. One is property and the other one is yield. Right? We somehow think that, okay, we need to have our capital intact. I just want to yield and all that. So a lot of times when we talk about CPF Life and CPF Life changes, people end up with these tables of calculating the value if I die at this age, if I die at the age and all that. For some reason, we think we can forecast when we die, we have a contract with God, or that somehow it's of much value to us to bring this into where we actually can't bring it. Right? So of course, I understand the move for legacy, but our advice is really that if it's about basic needs, then achieve certainty, the C, above all these other considerations of liquidity, of flexibility, and even of legacy. And on the next slide, we have a concept of the safe retirement income floor. So the darker green we say is a safe retirement income floor. So this is the die must have income. Die must have income means if you don't have it, you might die. Very simple. How much do you need for food? How much do you need for the dignified living? Right? And often you might have to ask yourself about 2 or 3 times to get to this income. It is easier to give yourself a figure when you are so closer to retirement age, or closer than if you're is right now. But there are reference points to help you there. So this is having enough when you need it. This is about enough. So for things that you can't play with, please be as certain as possible and avoid risk of capital loss so that you know that you will have it for as long as you need it. And in this case, is for as long as you are alive. We call this hedging and longevity risk. And the best instrument for hedging and longevity risk is annuity, which is what CPF Life is. Now, for additional lifestyle expenses that are, in that sense, optional or discretionary, you can take a bit of risk with that. So with this concept of the safe retirement income flow, let's go to the next slide. Yeah. So this is our calculation. And I would like to say that it's an interesting way of looking at that. So let's say BRS, FRS, and ERS, and these are the amounts at 55. And it grows in the retirement account. We use our analyzer to project what it might be. And then the CPF Life payout that is stated by the CPF board as a guide. Now, if you take the column called CPF Life payout and you divide it times 12 and you divide it by the projected capital sum, which is the projected RA, you find that the annual payouts as a percentage are kind of 6+%. Now, again, this is not yield, this is the payout. But if you insisted on replicating this, and again, I said, remember I said this is your die must have income, and you insist on using bonds, instruments that are pure yield. I asked a fund manager friend who is head of fixed income at one of our fund houses. I just said, you know, what do I need to get 5+%? And he said, high yield things I wouldn't touch. Okay, so of course there are other things like the fact that, you know, after about 5 years you need to refine or reinvest and all that. But the point is this, that the payout is as good as it gets, especially in relation to or in comparison with other insurance products. So at MoneyOwl, we have a view that's very strong that we don't think that anyone should be selling you a retirement income insurance plan if you do not yet have FRS, and you should not be buying that either on this basis, that we are prioritizing what you need in terms of CPF Life payout as your basic safe retirement income flow. So how much CPF Life payout do you need? We have a rubric, so you can look up our website under advice, it's a rubric. And we said have at least FRS, right? And this is the reason why. So this is the FRS amount on the left of 13,000, and the payout numbers, I think Albert gave you over time. And assuming that inflation is 2% per year, so look at the numbers got today's value. Now, when someone who is 55 this year turns 75 in 20 years' time, that payout from FRS would only be worth, purchasing power-wise, in the circled one, 1,155. Now, this happens to correspond to health span. And why we think about health span is because for retirees, you tend to spend more in your earlier parts of your golden years. Well, why is this? You are still healthy, you're able to travel, you're able to do things that they haven't done for a while. But once you get unhealthy, in the sense, health and care insurance may play a bigger role in your final years. And so at least look at that number, 1,155. It's not luxurious. We would say it is what we'll need for a basic and dignified living. And that's why we say, please at least have FRS. The household expenditure survey that was released at the I think beginning of this year or end of last year, showed us that the average retiree spending in Singapore in 2022 was around 1,384. That was average. Of course, there's a range. The lowest 20th percentile was much lower, and then the upper percentile was $3,200. So that's why we say, please have at least FRS, and please don't need to use any other instruments other than what is the safest, which is CPF Life, to give you this safe retirement income flow of at least FRS. Okay, so you might ask, what about using an escalating plan? So CPF Life has three plans. So please do not confuse them with the basic retirement sum. This is really how you want to receive your payouts. And the standard plan is the default plan. There's a basic plan, but I won't go into that today. But there is also an escalating plan that theoretically does hedge inflation because it does the 2% increase per year. But the problem here is that it starts off 20% lower, 20% lower. So it's only around 77 years old or so by our estimates that you get to the same amount as you would get on a standard plan basis. And if you want to do this value thing, then actually it's only around 90 plus years or so that you get there. But the main thing is not about the value. The main thing is that is $1,340 compared to 1,700 in those dollars actually sufficient for you. So that's something to consider. The other hack that you can use to increase your CPF Life payout is actually that if you're still working, you can delay your payouts. And this definitely helps you to beat inflation in those 5 years because for every year that you delay in your payout, you get about 7% more in terms of the payout amount. But again, this is your money, this is your retirement, you work hard for it. Whether you really want to do this is a question that may not be just answered by numbers. Okay, what if you need more than what was in today's dollars, $1,100? So I put then the ERS amounts and the corresponding payouts with what they are inflation adjusted or inflation deflated, right? So you see, again, what we recommend is that look at least the number around your health spend. And so for ERS, it will be about $2,200. So if you know that you sort of need something in between, say $2,000, then try to go for ERS if that is your safe retirement income floor. Of course, when you actually before you do this top up, if you are at 55 years old, pay attention to your cash needs then. So this is an example of how to think about it. So the reference points, as Albert says, gives you exactly that, references to whether you should be talking about just keeping FRS, which is the minimum that you should have, or even topping up to ERS using CPF Life. And this is our suggestion to you to have that frame to think about it. Okay, so what about additional retirement income beyond CPF Life? And this is where we use our CPFA framework again. And you can match different instruments against this framework. You might have slightly different assessments. This is our assessment. So retirement income insurance, as I mentioned to you, a kind of insurance, tend to be a bit chunky. And the return really is not as, in terms of the payout per premium, is not as good as CPF Life. So if you're not got an FRS, please don't go into this instrument. And where you see that there's a high probability of beating inflation, where the greens are, these tend to be in the investment space. But where it tends to be high in inflation, it can be lower on certainty. Why is this so? Because if in investing, especially in the capital markets, has risks. And so that is not an annuity instrument, it's no longer an insurance instrument. So there is a trade-off between this certainty and probability. Now, some people might think, oh, it's great to have a portfolio of bonds, you can ladder up the bonds and all that. But let's take a look at the A column, right? So the problem with this idea, and sometimes people have this kind of idea because they say, oh, okay, that's what my high net worth friends are doing, is that if you do not have enough cash in a big enough portfolio to have many multiple bonds, you can end up having concentration risk. So the same if dividend stocks, you can end up having concentration risk unless you have a lot of assets. So this is a hard fact of life, that when you have more assets, you can afford to lose more. And please note that even investment grade bonds can default. Nobody expected Credit Suisse to default, for example. Right? So that is what we want to share with you. That so what instrument would you use now? Of course, rental property is the same idea. Very chunky to buy a second property. everyone loves it, but you are actually putting quite a lot of risk in there, right? And in the case of rental property, flexibility also tends to be low. We have a recommendation that you may want to consider a total return portfolio and then redrawing from it in turn, which is kind of decumulation rather than a yield a yield play. And again, we ask you to respectfully to consider that if we do not have so much, that in order to provide for a very purposeful retirement, you have to accept some degree of decumulation. Now, if you do that in the total return means that it's not just dividend, you also depend on capital gain. There's some principles of investment you need to follow. First this is MoneyOwl's investment philosophy. I'll not go into it in detail, but you need to have the right asset allocation for your risk appetite. That balance of stocks and bonds, you need to be diversified. This is very important because if you start to select stocks, then again, it may not be reliable. You can have some big wins, but you can also have much larger losses. Low cost, very important. Every 1% of cost that you pay is 1% of return to you compounded. And finally, staying invested to reap the long-term returns of the market. And very important warning regarding retirement, I will give you. But on these four principles, we have actually worked with Phillip Capital to bring you these instruments that are from Amundi. They're basically low-cost passive funds, and they are covered on the Points platform. Now, the Points platform is a very old platform. It was my first one. It doesn't have any platform fee. It doesn't have any advisory fee because it's for DIY investors. And when we looked and curated investment solution sets, you say, hey, these are the solution sets that we have, and it's great. And for those who are investing on your own, the cost is as low as 0.05% expense ratio. This is not something you pay. This is something that's embedded in the fund that is part of the fund expenses, and it goes to Amundi, the fund manager. Now, there's no other trailer, there's no other referral arrangements, there's no platform fee, and this is what Phillips, which is a well-established broker, has brought onto its platform and switched it on just for these funds. So I think that we are looking at people who feel that, oh, I need to go and invest in the US, in the ETF, and there'll be all kinds of issues there. And those go down to 3 basis points, right? But why not then consider investing in Singapore dollars from $1 in a unit trust at for these expense ratios. So this is what we recommend to you. You can just go directly onto the Points platform to do this, or you can, if you want a link, you can just go to our OwlInvest page. Just now I said that I need to make some caveats about investing in a total return portfolio while redrawing, which is one of the strategies. Now, investing in accumulation is very different from investing if you are redrawing. You should not have the highest risk portfolio. The maximum is a 60-40. And the reason is that we have this very well-established rule called the 4% withdrawal rule. Now, this is a rubric, so there's a lot of chatter about whether it's still relevant and all that. Maybe it should be 3.5. It's a rubric. It's not a scientific logic. It's not something true. It's just what's been observed. And it's based on a 60-40. Now, I've heard and seen influencers talk about 4% withdrawal from 80-20. That's totally wrong. Right? It is a rubric and it's based on 60-40. Now, why is it that you have a time horizon to the end of your life of 15-20 years? You retire at 65, you might die at 85, so you think you have that time horizon. Why is it that you can't do full equities? After all, equities have not returned something negative if you had stayed invested for at least 15 years in the last 100 years. And this is data that I'm very familiar with, and we always use that to encourage people to stay invested. The reason is that 15 years in accumulation is not the same as 15 years in decumulation. And there's something called sequence of returns risk. I don't have time to go into it now, but basically it's a mathematical thing that if you're drawing down and if the portfolio, the market goes through a bad, say, first 5 years, you will actually end up running out of money earlier than if the portfolio had done very, very well in to start. So this, when you talk about data from fund managers, advisors telling you, oh, okay, this is the has always been the return has been 9, 10, 11%. Please be careful about it when you are investing while you're doing in retirement. Okay. Right. So there's a topic on CPF ordinary account, whether or not you should invest it. And this is especially after the closure of the special account, where any excess money that's above full retirement sum is actually put into OA rather than previously that high interest bank account of 4%. Now, before I go further, I'm assuming everyone agrees, and by now, that you don't invest your SA for those below 55. At 4% interest, that is effectively risk-free. It doesn't make sense when the instruments that you can invest in are actually much, much lower risk, much, much lower return as a result. Things like, money market funds and all that. Yeah, so should you then invest your CPF OA or leave them to earn 2.5%? Right. So this is, again, our suggestion on your decision rubric. Two sites with your above 55, which I think is an easier thinking, and then accumulators. What are the two preconditions that we recommend to you? Now, OA, as Albert had shared, is interesting because in Singapore, our retirement system has 3 pillars or 3 users, and one of them is housing. So OA is interesting in that way, and so please ensure that you can you might want to keep a buffer as part of your emergency fund to be able to pay your mortgage. Let's say 6 months, or if you're kind of freelancer, 12 months. So I myself, many years ago, I took a year out and I was paying my HDB flat out of my CPF. Right, and that gave me a lot of freedom. But it's a good idea because cash can become precious sometimes out of your control, and this is where OA can come in. Yeah, and of course, please don't have plans to use the amount in your OA for housing or kids' education if you are considering it for investments. So then, should you or should you not? Let's say you fulfill this precondition. So on the my left of the screen, if you're over 55 years old, it's a little bit easier because you already know roughly how much you think you will need. And you can consider, if you don't have FRS, please top up your FRS to minimum your RA to that, or to whatever is the corresponding level of retirement sum for your safe retirement income floor level. Okay, so let's say you have done that. Then you still have excess OA left. Do you have the risk appetite? Do you have the risk appetite to do this? And we'll talk a little bit about that. If you do have the risk appetite, then as I shared earlier, your maximum risk that you should take is really a balanced fund. A balanced fund is 60% equities and 40% bonds. Now, don't ask me why it sounds imbalanced to lay people, but investment people call 60-40 a balanced fund. Okay, and also exercise withdrawals flexibly. That when if the markets are down, withdraw a little bit less than what you might do. And then the investment principles, staying invested, low cost, all that apply. Okay, so this is the rubric we have for people who are over 55 years old. If you're accumulators, you tend to be a bit younger. It's a little bit trickier, but this is the rubric that we suggest to you. That firstly, again, consider topping up to your special account to FRS. So again, if it's for retirement, we say consider giving up this flexibility for certainty, if that is acceptable to you. Now, let's say you say, okay, I've done that. Then again, ask, do you have the risk appetite? Do you have risk appetite? Okay, I want to just caveat here that sometimes you may not know. You may not know, okay, I don't want to buy a house now, but I don't think I'm going to get married, but then who knows, I might meet somebody and I might want to do that. Then you probably may not want to top up all to SA. And the other, like put everything into SA from OA, because it is a one-way street and we have to be very careful about that. So you might want to do a little bit of both. It doesn't all have to be like so super optimized by banging on one point of view. And of course, between topping up SA and the investing, one gives you more flexibility, the other one gives you more certainty and it's safer. Now, do you have the risk appetite? If you do, then in this case, it's a minimum 8 years horizon. And very interestingly, what we recommend is the opposite of your 55. You have a minimum tolerance of 60/40. Next slide. We say that, if what would be option for accumulators of SA, right? So let's say you're willing to give up that flexibility, topping up your SA as early as possible can have a significant impact on your CPF life payout. So we model this based on the 3% wage growth, assuming, let's say, from day one, you're a 25-year-old, and you transfer 3% from your OA to your SA, right? And you do that all the time, religiously, right? Every year, you actually increase like 28% your potential CPF life payouts, right? And if you even this is worthwhile even when you're 40 years old, and you earn these median. These are all median incomes, median salaries, and you get a good uplift in your SA balance, and which, if you choose then to put into CPF Life, will give you about 15%. So that's why we say please consider topping up your SA at risk-free, which gives you risk-free interest rates, if you treat CPF really as for retirement. Yeah. So how do you assess your risk appetite for investing your CPF OA? So I talked about a long time horizon. Why is the long time horizon? So that it's improved the probability of your positive returns, that you can go through those downturns. But the key idea, as I said, don't be forced to liquidate because of your time horizon being so short at the bottom, and that eats into everything. And please understand that despite historical return being high, and it's a lot of times to do with which where your start point or the data is, with investments, you can always choose a data, you can always choose a date range that gives you the answer that you want to arrange your argument. But there is still some risk that you end up with a return that's less than 2.5% or even a negative return. As we know, past performance is not a guarantee of future performance. And even if you have time horizon, you must accept that there is this possibility. So the bottom line is 2.5%, which is a legislated minimum. It's a good starting point. It's a decent, stable return that has been guaranteed in legislation since 1999. So please consider, do you have this risk appetite? Okay, for CPF OA, unlike investing your cash, there is something called the agent bank fees charged by because you have to go through one of you set a agent bank CPF investment account with one of the three local banks, and there are charges for doing so, and these are absolute charges, which actually means that if your investment amounts are very small, the impact on your portfolio return can actually be outsized. And so we did very simple simulations here, nothing fancy, but it can actually take away quite a bit from your portfolio. So in other words, when you invest your CPF ordinary account, it benefits you if you do it in lump sums rather than trying in small amounts. So please be aware of this. Yeah. Okay, I'm nearing the end. I just wanted to tell you a little bit story of Mr. C. I'm not sure if Mr. C is on our call today, but he was an upset MoneyOwl client in those days when we were still doing direct advice and selling, which we don't do anymore, as I announced yesterday. Now, Mr. C was upset because he wanted to invest his money. He's 60 years old, and he took out his CPF money, and he really wanted to invest in the portfolios that we had at that time with Dimensional. And our client advisors, my colleagues, said, no, you need to do some planning. You need to do some, and so he got very upset, right? And so I got involved, and the reason is this: why did we ask him not to invest with us? Right? It's really because he was only getting $800 out of his CPF Life. And you need to talk to him to do planning, because when I ask him, how much do you think you really need? What is your die must have income? And it was about $1,000+. And on top of that, he didn't know whether he had his integrated shield plan, right? So, but what did he get sold, right? He got sold on the insurance side by a bank, a premium financed retirement income plan, without having yet gotten what he needed from our CPF Life. and he also got sold investments. Right? So I sometimes I tell this story to because it's in the context that we don't do any more direct selling, because it really creates a bit of it's difficult, right? When you have to sell funds and we understand the pressures of colleagues who need to do that, right? But let me just remind us that different people come from different angles when they ask you to do things, and I suppose not every advisor, not every fund manager has the luxury of where we are now in MoneyOwl by Temasek Trust to say that we don't have to do direct selling. But this is your retirement. Please don't do something and become only your advisor or your fund manager's retirement plan, right? This is true what you pay. What is important is what works for you, and what works for you is need not be fully, do not try to optimize on every single thing, then maximize, and you might actually end up being worse off. Just make sure when it comes to investments and your CPF that you have enough when you need it, right? So it is totally a reasonable thing that you treat CPF, including your OA, as only for retirement, and just keep things simple. I think that is totally a reasonable strategy, and to some extent, we would like ask you to consider that as your default. Okay, so I think that that's all we have in terms of presentation, and we're very happy to just move into the Q&A.
Hi everyone, I'm Vivian here, and thank you so much for staying to the end of the session. A lot of you are also asking whether there will be a video on this uploaded onto our YouTube. Yes, there will be. So we're just going to answer some of the questions that we feel are a bit more relatable, right? A bit more about your personal circumstances. So I think the first question that we would like to ask, that we like to flag up, which we thought was quite interesting, was, okay, I'll be saying it out here, but after that we'll type it out, so don't worry. Okay. So Mr. Melvin Xie, so sorry if I'm mispronouncing your name, but Melvin says that in year 2030, a 65-year-old retiree would need a nest egg of at least $550,000 to meet expenses based on conservative needs for 20 years. What do you think?
Okay, I think I will take this first question. Very good question, and this probably came up from the news report recently. In the last few days, DBS did a study, and yeah, $550,000 for conservative lifestyle, I feel is reasonable. Why? Because if we were to use the 4% withdrawal rule, it comes up to about $1,800 a month. And that is assuming that $550,000 you have in cash, and assuming you have a little bit more set aside in your CPF account. And if you are already 65 by then, if you have at least full retirement sum, you're looking at least $3,000 to $4,000 a month in totality for your retirement. So I would feel it's not that conservative kind of a lifestyle. It's pretty comfortable, in fact, if we were to factor in CPF. But if we were just look at it, yeah, solely based on your cash holdings, then perhaps yeah, $1,800 a month for 20 years might be a little on the lower side. But always remember, I think we try to stress many times over this evening's presentation that we want to use our CPF as a safe retirement income floor. Yeah, so that is my perspective of this situation. Yeah.
Okay, thank you so much for that, Albert. So the next question would be, does it make sense for a 75-year-old retiree who are on the old RFS scheme to opt in and participate into the CPF Life? I think whether you are in your 70s and you're listening to this, or if you have parents in your 70s and they're listening to this is a very interesting question. So over to Albert and Chuin Ting.
Yep. So for someone who is already 75 years old and on the previous retirement sum scheme, he would have already gotten a number of years of payouts under the RSS. So whether or not he should join CPF Life, there are really too many factors to consider. I think one of it, the most important being your current health span, right? We talked about how healthy you are. If you are someone who is still very mobile and very healthy, you are expecting many more years to go, then yes, definitely you should consider joining CPF Life because of the lifelong payouts. Yeah, but today, if you have other concerns, you are, medically, you have other commitments as well, then perhaps it may not be worthwhile for you to switch over to CPF Life as well. Yeah, so
Yeah, I think just to add that I think you can take some guesswork out of this by going to CPF board and asking them that if you did opt in, what is the differential in terms of the payout? Yeah, so I think that's the starting point to assess whether it's something that's worthwhile for you.
Okay, thank you so much for that. Next question, and this is kind of a combination of a lot of your questions here also. There are a lot of people who are asking, what if they do not hit the DRS? What should you do?
Yeah, to put it in context for currently, we actually have, I think, about out of all CPF members that turn 55, there are about half that do not hit BRS. That is something that you can still join CPF Life as long as you have 60,000. So, but I think from the question's point of view, if you're thinking about how do I get more retirement income, please consider housing monetization. The HDB has a lease buyback scheme whereby they also give you some bonus if you sell back part of your lease and then put it into CPF Life. That's one way of doing it. The monetizing home through renting out a room and other things are there. So these are the options from the retirement income point of view. Yeah. So I think if you're talking about the rules point of view, Albert, you want to add?
Yeah, so if you do not hit the basic retirement sum, it's not a strikeout, right? It's whatever you have at that point of time. Yeah, what else can you do? Continue working, continue trying to build up your CPF savings. It's not a strikeout for sure. You'll just be getting comparatively lesser based on whatever you have accumulated so far. And on the topic of whether or not you should be using your property in place of half of the full retirement sum, or what we used to call pledging of your property, you may consider, but do go in with do be aware that if you were to use this option, you may get more withdrawals earlier at the age of 55, but at the expense of lowering your CPF Life payouts from the age of 65 onwards. So there are some considerations in there as well, but by and large, it's really not a big deal if you can't hit the BRS, like I mentioned earlier as well. Take these as reference figures, right? And yeah, it's basically okay. It's okay if you do not have that. Yeah.
Yeah. So of course we talked about the match retirement income savings scheme.
Yeah.
You know, so that is really if you do not have BRS from 55 years and onwards, right? So that's something to really consider where it can be helpful to you.
Okay, maybe we'll just do, now it's 8:55. What we might do actually is to extend this Q&A by a little bit, but if, let's say, 9 p.m. hits and you guys want to drop off, please feel free to drop off as well. It's very late and there's probably work tomorrow. Maybe just a few more questions that are slightly more investment related. So Lawrence asked, if the investment horizon is 8 years, is it recommended to do a lump sum or interval sum? For this question, let's just assume that we are taking it in the context of retirement. And let's have one answer related to cash investments, one question related to perhaps CPF investments. And I think we can reiterate our stand on CPF investing once again. Over to Chuin Ting and Al.
For investment horizon of 8 years, for accumulation, we roughly think about kind of balanced fund, right? Yeah, that means 60% equities and 40% bonds, because historically that has been what did not end up with a negative return. But again, you know, that's past returns are not indicative of future returns. Is it recommended to do a lump sum or interval sum or kind of DCA? If mathematically speaking, if we believe that in 8 years you're going to be up, then it's actually better to do everything right at the start. But sometimes on these investment things, it is as much psychology as anything, right? So people feel that, okay, if I invest a lump sum, and I happen to be investing at a little high, you know, should I actually tranche it out? So I think you can, but please have a plan, because the emotion is always the enemy in investing. So if you know that mathematically speaking, we're talking about very high probability of doing quite well in the kind of buy and hold. But if you can't bring yourself to do it, then tranche it out, but then don't take like 8 years to do it. Yeah, because you don't have that time horizon for each of them to that. So take it like, say, in 1 year or 6 months, you know, and just be disciplined about it, that I will do this no matter whether my idea that the market is going up or down has turned out to be correct. Yeah. So for CPF OA, I think it's like I mentioned, the idea is more on the whether or not whether you're withdrawing and all that, you have to take that into account, of course, your cost, because I'm not sure what is your investment amount. The trick is CPF OA is that your alternative is that 2.5%, right? So perhaps it's not that much of a urgency in that sense to do that, versus this being your main accumulation strategy.
Okay, thank you. So there's one question, right? Is a 60-40 portfolio still effective in diversifying risk? The past 2 years have shown both stock and bond movements moving in lockstep with each other. And for context of some of our listeners here that might not be as investment savvy as others, maybe we could also give a explainer on what the 60-40 portfolio is like as well.
The 60-40 is known as a balanced fund, and it's also sort of known as the default universal portfolio, right? And it's done historically done well, and it's because bonds actually have, generally speaking, been okay, you know, in that. But in the last 2 years, the issue is really that the bond markets have performed very badly, because we came up from a very extremely low interest rate environment, and then it suddenly moved very fast, and then, you know, when interest rate goes up, bonds come down. That said, you know, we are not yet thinking about revising that whole construct of risk and return when it comes to bonds over just because of the 2 years of data, and then particularly 2022 to 2023. So I think that's there's quite a lot of debate. I would say that also the question about whether this is about diversifying risk, I'm not sure, because I would say that, is this the right portfolio for you? Depends on your need to take risk, your need for the return, and your ability to take risk, which is your time horizon, and your willingness to do so, right? So diversification is really that within your 60% equities, how many counters do you have, how many sectors do you have, and 40% again, you know, is that. So it's like a 60-40 portfolio is still has a risky, it's still high risk, and I'm not even talking about the last 2 years. I'm talking about that it has that drawdown that I've shown you. It does come down quite significantly during times of drawdown. So it's not that you have 40% bond or 50% bonds, or you balance this out and it's all weather. It's actually it's very hard to say that anything can perform anyway just because you add some bonds. When you add bonds in, what it does is that there's a different risk return profile, such that when it goes down, it doesn't go down as much as the 100% stocks. I suppose that's really how a 60-40 should be viewed. And for now, I'll say I'll take the long view. rather than just in the kind of past 2 years that I don't think structurally the markets have changed really that much. Yeah.
Okay, this is a question that has been upvoted quite a bit. Can my parents immediately draw out money from the RAA account once I have topped it up?
Yeah, this is a very good question. The short answer is no. Whenever you put a top up into the retirement account, it will only be streamed out, or in CPF board's terms, they will be annuitized. Meaning, when it reaches a certain amount in your retirement account, let's say if you have already started your CPF LIFE payout, right? So what CPF board will do is when it reaches a certain amount, they will annuitize that amount again, and you will add on to whatever CPF LIFE payouts you are already getting. So short answer is no. If you have already topped it up into the retirement account. So that is one thing that you should be aware. If you are considering top-ups into retirement account, they only come out in the form of CPF LIFE payouts.
Okay, and I think this is all for our questions. I know everyone has submitted so many questions, and we are so excited to see everyone so passionate about learning more about CPF and going towards financial security. It's 9:02 p.m., so thank you for staying with us till the very end. And we actually anticipated that there will be a lot of questions because CPF is a complex topic and it does require some guidance. Even I personally, before I joined MoneyOwl and I got into the personal finance space, I would say I was quite a noob at CPF and all of these. So we have run out of time to answer your questions, and you can ask them in this Telegram community group that we have just created. You can scan the QR code here to join. My computer just pinged, so I just saw someone joining. I'm gonna unmute my computer. And for a copy of the presentation, please scan the QR code on the side. Thank you so much for attending, for taking your Thursday evening here with us. And just a caveat as well, that as you start to ask questions in this community channel, we do seek your patience and understanding if we cannot get back to you straight away, especially during non-working hours. But when we can, we will get back to you. If not, we encourage a community of sharing with each other and answering each other's questions. I do see that some of you here are also CPF mavericks on your own, so we encourage a very encouraging and fruitful conversation over there. Thank you so much for tuning in, and good evening.